Okay, terrific. Thanks. Actually, I'm going to go very quickly. I made very few slides, and it's meant to be an introduction, really. And I just wanted to make a few key points to give people something to think about. So I'm not going to drag on and spend a lot of time and talk too much, and I'm not going to show too many slides. I want to leave a lot of time to answer questions. And so that's why I think it might be better just to wait until the end of the slides, and then we'll answer the questions. So I wanted to first just make an overview statement about the options market, and especially about the weekly options market. And what's happened is really pretty simple. There's a lot of words on these slides, and I'll leave that to people to read. I'm not going to read these slides to people. But the most important thing is that the weekly expiration that started a few years ago, has really exploded the option volume and open interest. And it's created a new level of efficiency in the options markets. And until that happened, a lot of people had strategies where they sold time decay. They did various things. They sold strangles and straddles and condors and butterflies and all kinds of trades where if the stock didn't go up too much or down too much and time decayed properly, they would make money. And in fact, one of the best ways to do that was to sell some kind of structured position before a weekend and then collect the time decay on Monday morning. And then the options market became more efficient. And so you would actually have to sell that position early in the day Friday because the prices would collapse in anticipation of the time decay of the weekend, and it became more difficult. And then the options market became so efficient after weekly options became popular that even that trade has basically gone away. There's virtually no way to structure a trade that makes money from time decay, even taking advantage of the weekend time decay. And it's because the time decay goes out of the option positions in such a way that the skew changes and the bid-ask spreads widen and all sorts of things that accommodate that. So for a retail investor trying to fill a trade, it gets very frustrating. You know, the bid-ask spreads, let's say you have a trade that has 3 components to it. The bid-ask spreads might get to be 40 or 50 cents or 60 cents on that trade, which will be more money than the entire time decay of the weekend. So selling time decay, now that the weekly options have exploded onto the scene, has become in some sense a fool's game. And there are millions of people out there trying to do it, and in fact, many more than there ever were in the past because of the weekly options, because people feel like they can always sell options that have very fast time decay because it's the final few days. And those people are actually having the effect of driving down the implied volatility priced into options every week. And because of that, they've created a tremendous opportunity for people who understand the mathematics of options trading. And that's what this is all about. And so this particular trade that I'm going to talk about, the weekly short butterfly, capitalizes on that exact set of dynamics, the fact that there are millions of people out there trying every week to sell time decay and collect money on options that expire in just a few days. And I'm not only going to show you how those trades can make a lot of money in a time frame of 1 or 2 days, but I'm going to show you how at the very end on Friday, when it seems like time decay is just extraordinary and people traditionally have jumped in the market to try to sell straddles and strangles on expiration day, that's actually one of the very best times to take the other side of that trade and to put on a short butterfly or a back spread or something that makes money because of a large move of the underlying stock. And we'll see how the trade gets very sensitive to any movement at the end. In the final, we're actually going to go down to the final few minutes and see how that works. But just to get a feel for how popular these weekly options have become, here's Apple Computer, and I took this week. Here's the open interest on the call side. I went up and down eight strike prices. I think it's 8 on one side, 7 on the other. I went up and down 8 strike prices, and same with S&P 500. And you can see almost 70,000 open interest puts and calls together just on Apple, just on these near strike prices, and on the S&P 98,000. And these are weekly options. These are just weekly options. If you take the top 10 stocks in the S&P 500 and total this up, the volume and open interest each day is just enormous on on these options. This dwarfs anything that we've ever seen in the past. In fact, every day in the first minute of trading, more options change hands than in all of 1990 now, I think, is the current statistic. It used to be 1985 or 6, but I think now they're saying the first minute more options change hands than in the entire trading year of 1990, which is a shocking thing.
In the first minute of any trading day, you're saying?
Any trading day, Monday, Tuesday, Wednesday, any day between when the market opens at 9:30. At 9:31, there have been more option trades than there were in 1990. That's a shocking number, but I mean there are literally. I mean, I was reading the other day about a very large investor that bought 1.3 million put contracts, and there are a lot of things going on. I mean, look at the volume on the S&P. Look at the put side. There were 19,000 calls and 78,900 puts in the open interest, and that's a weekly. That's a weekly option series expiring that week. Expiring this week. So. And I'm sure the open interest is even more now. So these are big numbers, and it also tells you what the view was of the market. I mean, look at this. Just below the strike price, there's 14,279 puts just below the trading price on Friday. Now, just to show you how volatility is underpriced in these short time frames because of all the people trying to sell time decay, in the last 100 days, Netflix averaged a strike price cross every 312 minutes. Apple averaged a strike price cross every 234 minutes. But the implied volatilities for Netflix and Apple were 37% and 28%. Now, the trade that I'm going to talk about today, the short butterfly trade, actually makes money with less than a whole strike price movement. If you structure one of these short butterfly trades on Apple, and Apple moves a strike price, the trade makes money. Well, Apple averages a strike price move every 234 minutes. And so if you get a week with a lot of movement, you cross 2, 3, 4 strike prices, it's a tremendous opportunity. Not only can you just replay the trade 2, 3, or 4 times, but you can keep the original trade and generate a 100% profit. So it's really, really shocking, and yet on the other side of that are still millions of retail investors who are trying to sell all the time, sell strangles, sell straddles, sell condors, sell anything that has time decay, and it just always tends to blow up. Sometimes you get some calm weeks. In fact, recently, this 100-day number changed a lot. When I calculated this 100-day number back in March, Apple was crossing a unique strike price every 150 minutes, something like that. The number has gotten longer because we've had low volatility and very calm markets recently. But even in those time frames, today we had Netflix jump up $12. We had Apple the other day jumped up $15. So we've had a lot of moves. In fact, we had Apple up $25 a few days ago. So we've had a lot of these big moves even recently, even in the low volatility environment that we're in, where the VIX is tending to be 13, 14, that kind of thing. So again, this one little bullet, this one little statistic is very significant because it doesn't bode well for people trying to sell time decay, and it tells you that option pricing theory doesn't work in the final few days, and especially when you have something priced with 28% implied volatility that crosses a strike price every 234 minutes. That's just way too much. So let's talk about what this short butterfly thing is. Short butterfly is a margin-friendly trade. Don't have to have a lot of money to do it. There's no naked short position here. It's very low risk. You can only lose the amount of the credit of the trade. Well, you can lose a little more. You can lose the money based on the distance between the strike prices. It's very high return. I say high return because it's repeatable and it scales and you can do large trades. So they are very high return, and on a percentage basis, there's almost nothing you can do that has this level of safety and this quality of return. And it's truly chipping away at the market trade. So a typical example might be you're short 10 100 calls of some stock. Let's say the stock's trading at 110. You're short 10 of the 100s. You're long 20 of the 110s, and you're short 10 of the 120s. 10, 20, 10, 1 to 2 to 1. And you're long the middle strike price. So you're short 1, long 2, short 1 at these 3 strike prices. And let's say the credit on this trade is 85 cents. If the stock expires below all the strike prices, they all go to zero and you keep the 85 cents. And if it expires above the strike prices, you would also have you would keep the 85 cents, because let's say the stock went all the way to 200. That would mean the 100 call would be 100 points in the money, the 110 would be 90 points in the money times 2, and the 120 would be 80 points in the money. And if you calculate 1, 2 to 1, short, long, short, you'll see that that all cancels out to exactly zero, and again you would just keep the 85-cent credit. So whether they all expire worthless or they all expire deep in the money and are worth zero in total as a net price, whichever way it goes, you make the 85-cent credit if the trade has an 85-cent credit. Now on Friday, when you put this kind of a trade on, the trade has a credit approaching the full $10 between the strikes. And so that's what we're going to talk about. The idea isn't so much that you keep the trade until the end. The idea is that you get a significant move of the underlying stock, and that significant move generates the return. And we're going to see some examples of that. The maximum profit of the trade is equal to that 85 cents. And like I said, the simple case is the stock moves below the strikes and it all goes to zero and you keep the credit, right? The more complex calculation is it expires deep in the money. And again, this blend 1 to 2 to 1 would add up to a net of zero if that happened. And what would happen is you would keep the credit. They balance each other. Some time frame should be avoided. If you look at Thursday afternoon with 1 day remaining before expiration, the trade is finally weighted against you because time decay is so huge. 100% of the value of the trade has to evaporate in the next 1 day, and you have the overnight time frame, which is most of you have an entire evening, which is more than the remaining time left in the option contract to trade. And if you just take the dynamics of time decay and the distortions in option pricing, it's probably not a good idea to put one of these trades on Thursday on options that expire on Friday. There is significant time decay. Much better to put that same trade on Friday morning and just hold it for the 6.5 hours that the market is open rather than just sit on it overnight, because time decay does work against these trades. These trades are taking the other side. These trades make money because of movement or rising volatility. They don't make money from time decay. They lose money to time decay. Wider spacing between the strikes makes the trade more sensitive to movement. That's counterintuitive. If we had spaced these $15 instead of 10, the trade would actually be more sensitive to a small movement, but it would also have some more time decay. And adjusting the strike spacing makes it possible to place trades that are profitable in any time frame because of that. So we could put a trade out 3 months, but we could space it by $25 and get some of the same effect. There's no real reason to do that, but I just wanted to point that out, that's a possible scenario, is to place the trade further out in time with wider spacing. I don't like to do that. I put these trades on Monday, take them off on Tuesday, put them on Tuesday, take them off Tuesday afternoon, put them on Friday morning, take them off before the close. That's the kind of trade that I do. The following data was collected last Friday, and so let's just talk about this. So we have stock at 503. That was Apple. It was 503.10, I think, right at the close or right before the close. And so there were two possible butterflies. You do the 490, 500, 510. So short, long to short. Or you could do 495, 505, 515. So you could be short the 495, long to 505s, and then short the 515. You could do either one of these because it was in between. So I marked them both. Here are the prices for the net trade: $1.90 credit and $2 credit. Very similar. Now, this is probably the least effective, really, day to do the trade. We're doing it before the weekend on Friday. The time decay is weighted against us. I purposely chose that for this week to show this trade. This is a much better trade to put on Monday or Tuesday. But I wanted to just show how sensitive it is to movement. If you put this trade on, let's say at 3 o'clock in the afternoon Friday, and there was a piece of news, and Apple moved $10 just on a piece of surprise news, the trade would make this much. It would go from $1.90 to $1.45. Or if it climbed, it would go to $1.40. Same, pretty much the same in both directions. Although as you keep moving away from the strike price in this direction, the down direction, which is up, then the prices do get a little more distorted. But the point is, a $10 movement, which on a piece of news is nothing, generates a significant profit. Now, if you put this trade on Friday afternoon near the close, the price on Monday morning is almost going to be the same. What happens is implied volatility begins to shrink near the close to accommodate the weekend time decay, and then it rises again on Friday morning. Plus, near the close, the bid-ask spreads are wider, and that's also figured into this midpoint price. On Monday, the bid-ask spreads are more narrow. So you could really put this trade on Monday morning, and then as soon as Apple moves $10, which it does all the time, as soon as Apple takes a $10 move, then you can close it for a profit. So that's what an Apple $10 space short butterfly with 7 days remaining looks like with Apple in between these two strikes. You just pick one of these two. And in fact, I would pick the second one because it has a slightly larger credit. The time decay is only, for this trade, was only 10 cents a day. And that's because there's a whole week remaining. That will accelerate to where the time decay is measured in dollars. Now let's talk about Friday. Friday is one of the best days to place one of these trades. The distortion in the final 30 minutes is enormous, and all of option pricing theory goes out the window when that happens. What really happens is that it becomes a market where people are betting real money on real movement. I think it's going to go up. I think it's going to go down. I think it's going to pin to the strike price. I think it's going to move away from the strike price, or it's at a strike price. I'm going to buy a straddle and hope for a move. It's real people with real money betting. That's what Friday expiration becomes. And that's what creates strike price pinning. Stocks rise. They cross a strike. People have calls that are in the money. The distortions are huge. People overpay to buy back in the money calls and all kinds of things. So Friday can be a very exciting day because of all of the dynamics around people rolling positions forward and closing positions and getting out of covered calls and selling the next week's call and things like that. And if a stock suddenly rises above the strike price, all of the retail investors who are short calls panic by overpaying to buy back those calls. The institutional investors are on the other side of that trade, and then when the stock falls again, which it inevitably does, then the institutional traders buy back their calls and do their sales and sell puts and all kinds of things like that. So it's always the retail customers lining up to bet against the institutional customers, even though they don't feel that way. They don't know that. Let me show you some of the dynamics of the last few minutes. So like I said, if you put on a short butterfly where you own the middle strike and you sell the outside strikes, if you put on a short butterfly in the final half hour of trading on any stock, but let's just take Apple or Netflix, one of the more expensive stocks, Amazon, stocks that trade in the $100, $200, $300, $400, $500 range, those kinds of stocks, typically the credit for a trade in the last 30 minutes is going to be somewhere in the neighborhood of $4, maybe more. Sometimes almost the whole $5, because especially if it's sitting right at a strike price. So let's look at the statistics. What happens in the final 30 minutes? Well, I took 25 expirations. I made this chart on March 1st, so it ends on March 1st. But I took the previous 25 expiration Fridays. I took the final 30 minutes and the final 15 minutes to look at the average change. And what was more important to me was the absolute value. That's why columns 3 and 4 are here. It doesn't matter if it was down or up. What matters is how much it moved. And I took the absolute value so I could calculate an average of the average size move. I didn't want plus and minus because that would affect the average. So I took the final 30 minutes and the final 15 minutes, and I took where the stock started with 30 minutes to go and where it ended, and where it started with 15 minutes to go and where it ended. And I took the average size move, and in the final 30 minutes, Apple was averaging over 25 expirations, a $2 move in 30 minutes. And in the final 15 minutes, it averaged $1.87. But even more shocking was when I took the high minus the low. So if you said, how much did it actually move from high to low or low to high? How much did it move in the final 30 minutes? It averaged $3.87. In the final 15 minutes, it averaged $3.27. Those are big moves. Final 15 minutes, absolute move from where it was to where it closed, $1.87. High-low in the final 15 minutes, $3.27. Now, if you put on a short butterfly and you get a $4 credit, a $1 move makes profit for you. That's all you need, because the person on the other side of that trade needs the stock to move less than $1, because he's paying, that person has to pay $4 for that trade. He needs his first strike price to be $1 in the money. So Seth, this would be a good time. I know that you have a chart that shows the risk analysis around this particular trade. So maybe I should hand you back the screen. You could pull that chart up and we could talk.
Yeah, that's fine. Yeah, it's a risk graph from OptionView that I'll be showing to show the initiation of this Apple trade this past Friday. And here, I'll just open that up for you. This is so as you can see, per Jeff's point, any expiration price above 510 or below 490 would produce, a result of you being able to keep the entire credit for those mathematical reasons that Jeff just explained. So you'll recognize this is an upside down butterfly, basically.
An upside down
Fair
butterfly.
Enough? Yeah. So that, in other words, we just went into Friday, and we set up this 500 center short butterfly. The wings, short wings at 510 and 490, and the 20-point center long, and then that creates this risk graph. So it's just to kind of emphasize and give you a pictorial view of the way the trade would play out over time, and ultimately at expiration is the red line. So just thought a little show and tell might be helpful for today's presentation.
Yeah, and I think that it seems to me I'm the only one who doesn't look at these graphs all the time, and I'm not sure why. Everybody tells me that these are very helpful to them. So I really encourage people to look at these kinds of charts. Even if you kind of move away from them over time, I think it gives you a feel. You put up the trade, you look at time slices, and you look at returns and sizes of movement, and it gives you a good graphical way to see the whole trade in one blink. Maybe the reason that I don't use them much is there are other dynamics like rising and falling volatility. So for instance, if the volatility suddenly shot up because the market fell, you would make money not only from the movement but from the rising volatility, which decreases the size of the credit. And so I try to keep a lot of dynamics in mind: the opening behavior, when the market first starts, how the market behaves towards the close, the bid-ask spreads, the overnight time decay, rising and falling volatility. And I can't really picture these dynamics on this chart, so they layer on top of that. So the chart is a very important starting point to understand the trade. But then above that, it's even better to think also about rising and falling volatility and model the effects of that.
That's right. All right. Well, we'll give the screen back to you, Jeff. Had you finished on that final slide, or?
I'm almost there.
Okay, great. Now take your time. I just wanted to know where you were in the presentation.
So I wanted to step through a trade. There's actually 2 more slides left.
Great.
And
that's great.
so I wanted to step through a trade that went for the whole week, last week. This was Netflix. And then I wanted to show kind of the Friday behavior more precisely. So let's just take some midpoint prices for Netflix. Netflix has been in the news quite a bit, and Netflix has been moving around. They've had some surprise earnings reports and things. I try to divorce myself a little bit from some of that and just focus on the underlying mathematics. But it's not as if I don't pay attention to what the stocks are doing. I used to say, to me, they're just tickers, and I'm just trading the letters in the ticker. I don't care what it is. But that's not really true. I purposely focus on times when I think the stock might become more active, when there's a good possibility of news, or avoid the stock when it's in a calm period coming up a month before earnings and I don't think anything's happening and there's no announcements, or after it had settled down. I try to keep my eye on stocks that are in the news, so to speak, that are moving around, that are active. And so Netflix recently has been one of those. and they've been negotiating deals for content and things. So here's an example of Netflix last week. Monday morning, right at the open, in the first minute, that means Monday morning with option expiring Friday. That's 4.27 days until expiration, and I'm counting expiration at the close on Friday, because even though the option contracts might expire Saturday at midnight, weekly options don't. They expire Friday night, and so there's actually a difference, and the truth is they can't be traded after the close on Friday. So if you want to actually count Saturday at midnight as the final time for an option, if it's a monthly option, then you have to take the volatility to 0 at Friday at the close. And I found it's just simpler for theoretical calculations to just keep the volatility normal all the way through to the end and say the option expires Friday afternoon. That's just a fine detailed point that I want to point out. And that's why I listed it as 4.27 days remaining until the actual close. But let's say Monday morning we did this trade at 9:30. The stock was at 250.42. And this is the butterfly we did. 245, 250, 255. $5 space. We're short, long times 2, and then short. So we're long the middle strike times 2. Here's the prices of the options, and here's the credit for the trade. Let's say we did 10 contracts, 10, 20, and 10. So here's the credit of the trade, $970. Okay, so it's a 97-cent credit for this trade. $970 for 10 contracts. Okay, now let's follow the trade and see what happened. Well, Tuesday morning at 9:30, when the market opened in the first minute, with 3.27 days remaining, the stock price was 258.84. It took an $8 move. Okay, if we close the trade right then, here's the same trade. Here are the prices. So the short 245 call is $14.08. The middle strike is $9.63, and the high strike is $5.88. If we close that trade, we would only have to pay $700 to close it. So we would have made 28% on our initial credit. So our credit went from $970 to $700. So we sold it for $970. We bought it back for $700. That's why. This is what I call chipping away at the market. It's not a bad thing to make $200 on some trade every single day. That's a lot of money. I think people don't realize how that adds up. This scales, though, because these are low margin trades, and you can put on many of them. And the more you put on, the better chance of something blowing up. So it's not people who sell time decay have the opposite problem. They put on 10 trades and they get killed every day on some trade. Whereas if you're buying time decay like we are, you put on 10 trades and 2 of them blow up every day. So this is a pretty common occurrence. But let's keep going. Let's say we took that Monday morning trade with a 97-cent credit and we held it until the close on Friday. At the close on Friday, the stock was at 258.87, only 3 cents above where it was Tuesday morning. But that's completely outside the range of the strikes. Here are the prices, and you actually would keep 100% of that credit. So you would make the full 97 cents. So you keep the $970. Now it's getting more serious. You would actually have made $1,000 this week on this trade with 10 contracts using very little collateral. It uses the same amount of collateral as buying a stock that costs $10. It's the spacing between the, or $5. It's the spacing between the strikes. Now let's say that Friday morning we decided to put on the trade. Friday morning, if we put on this trade, we would have done a different strike. The stock was at 251, so we would have done the 240. Oh, same. Actually, that's right. 250, 255, 245, 250, 255. The credit of the trade is 28.60. Credit of the trade is 28.60. Much more because there's much less time. Time decay is very high. The time decay sellers would tell you never to do a trade like this. You'll get killed. You lose all your money. They would be selling strangles and straddles. They'd be selling the 245, 255 strangle or the 250 straddle and hoping that it pins to the 250 strike. There'll be 10,000 people out there betting that this stock will fall $1.20 back to the strike price. And it did actually move up and down. When it crossed the strike price, there were thousands of people out there selling 250 straddles and trying to get the time decay. It doesn't work anymore. That trade it very rarely makes money anymore. It's a very dangerous trade. And if you put this trade on, if you did the short butterfly, the $5 space short butterfly centered at 250 for 28.60 credit, you would have kept the entire 28.60 because the stock moved up $7.67 and it closed above the top strike price, completely outside the range for a full credit. That's the kind of trade that is completely changing everything right now, because the time decay sellers don't know how to cope with this. They keep trying their best to sell time decay, and the institutional traders are taking the other side of those trades. So when you do this kind of trade like I just showed here, you're betting with the house essentially. And I didn't even optimize it. The reality is it would have been better to wait for it to move to a strike price and to put on the trade, and that takes us to the last slide. What would happen if we waited all the way until the end of the day, Friday afternoon, with 1.5 hours remaining at 2:30 in the afternoon? That's 0.06 days in option pricing theory terms. The stock is at 256.90, not exactly at a strike. It's actually $1.90 above a strike. But let's say that we took this slightly imperfect situation. It's 2:30 in the afternoon. We only have an hour and a half left. The stock is not really at a strike, so the trade is a little bit biased to one direction. It makes more money in one direction than the other. But that's okay. We'll still do the 250, 255, 260 trade, that is a different strike than we were at before, because we're at 255 right now. This is the price of the trade. The credit was $3.09. So our 10 contract trade was worth $3,090. Well, actually, in the last hour and a half, the stock moved, and it closed at 258.87. Not a tremendous move. Not a tremendous move. It's the same. It's this move that you saw here on the previous slide, but we waited till the final couple of hours to put this thing on to see how it would do. We're not even at a strike price, and look what happened. It's above the two. It's just below the top. It's just above. It's just in the money this much. It's just below the 260. The 260 goes to 0. It didn't. In this case, the previous case, it moved outside the strike range, but because we recentered it at 2:30 in the afternoon, it actually did close a little bit below the top strike price. So the 260 goes to 0. We're short the 260, right? The 250 is worth $8.87, and the 255 is worth $3.87. These are the actual prices at the end of the day, right? And the trade is now worth $11.30, and we can buy it back for that price. So we put it on for a $3,090 credit. We buy it back for an $1,130 debit, and we make 63%. That is a big profit to make in an hour and a half on 10 contracts with almost no margin and very, very little risk, because the only risk that you have here is the worst case, the stock moves down $1.90 and sits at this strike price and doesn't go anywhere. And if that happens, you can always make the decision to stop and close the trade, because the only risk is time decay. Movement is your friend. So all we needed was a small movement. This is a very subtle movement. So someone taking the other side of this trade is paying $3.09 and betting that the stock won't move just $2, just under $2, is betting that the stock won't move that much, and that's a dangerous bet. So the stock moved from 256.90 to 258.87, and the trade made a significant amount of money. And so that's what I wanted to show, is that, and we've gotten more extreme. We started talking about trades that are a week out like this, and we showed that a small movement, a strike price, makes money. Then we started talking about Monday morning to Tuesday morning, Monday morning to Friday at the close, and then finally we did a Friday morning to Friday at the close, and that made money. And then here we are Friday afternoon with an hour and a half remaining, not even at a strike, not symmetrical, a lot of things against us, very fast time decay, not much time left. The stock only moved a small amount, and the profit was tremendous. And this is pretty much the story all the time. And the real moral of the story is, even if we were wrong, the time decay is our only risk. And if you put on a dozen of these, it's very unlikely that one of them won't take a significant move. So those were all the slides I had, Seth, and I thought that, you know, maybe now I would just stop and I could answer some questions.
Well, that is a noble purpose, but we have so many questions, it's not going to be possible for you to answer them all.
Are there any overlaps or
well, there are overlaps. So what I'm going to do is sort of start and try to see if I can, wow, they just keep coming in and in and in. So I'm going to see if I can start to sense like a category of questions and just try to cover that whole category.
Okay.
That's going to be a little tricky, so I will simply do my best.
Okay.
All right. There's a whole bunch of questions about fills. And, you know, what is your experience with the fills? Friday, within a couple minutes of the close and so forth. What are your experience?
The market is so active and the volume is so high. On Friday, if you take any of these stocks, Amazon, Baidu, Apple, Netflix, Caterpillar, Steel, Goldman Sachs, any of these big name stocks, even the ones that are low volatility, IBM, things like that, Caterpillar, if you take those stocks and you get anywhere near the close, the volume is so high, especially in the last half hour, that everything fills instantly. You deal with pennies, a penny difference. And the bid-ask spreads actually get very narrow near the end. Sometimes the deep in the money component, like what I have on the screen right here, the 250, 887, that price you might see a bid-ask spread get a little bit bigger, but I'm talking about an $8.80 option, let's say, or an $8.50 option with maybe a 15-cent bid-ask spread. My experience on the middle strike and the far strike is that the fills are excellent. And not only that, but on Friday you'll see the open interest is less than the volume on these. A lot of times you'll see one of these popular stocks like Apple with open interest of 5,000 contracts on one of these strikes, and it'll trade 20,000 contracts on that day, which means every contract changing hands 4 times. So I think the fills on Friday are better than almost any other time. And I always put things always in the middle. And sometimes I even give up a penny or two. I found over and over and over that if I'm too stingy on the trade and I try too hard to get a slightly better price, I end up missing something that makes, like this, something that makes 63% that turns $3,000 credit into a $1,100 debit, and I could make $2,000 on 10 contracts. I end up missing the whole thing trying to get 10 cents better. So I usually get to the midpoint of the whole trade, and I give up a penny or two in the rounding, and I get it filled. And the fills are excellent, really. I use TradeStation for a lot of my trading. I know people say it doesn't have the best option platform, but the reason I like TradeStation is they're not a market maker, so they don't ever get in the middle of your trade, and they really do have an interest in getting you the best fills on whatever exchange. A lot of the other brokers have more interesting, easier to use platforms for option trading and more visual platforms with better charting capabilities and things. But a lot of them are market makers, and they get in the middle of your trade and they're buying and selling from and to you, and that interferes with the fills. So I actually like TradeStation for my purposes because they never ever get in the middle of your trade. I look for brokers that are not market makers. Okay. I'll stop there. I don't want to go on too much on each.
There's another sort of group of questions which I think is really interesting, which involves, is this essentially an anti-pinning trade?
Well,
yeah, go ahead.
Yeah, this is a good question. So pinning has changed. I think the basic concept of pinning was very distorted at the beginning because it's not so much that it expires at a strike price, it's that the stock hovers around a strike price, trades above and below and above and below. That's really pinning. And actual pinning behavior has become more rare with these weekly options. Stocks tend to jump from one strike to the next a lot more often, and they tend to trade a dollar, like Apple will trade $1.50 above and then fall a little bit and then rally to the next strike. You don't see as much of that traditional pinning behavior where the stock zeroes in on a strike price and sits there all day like it used to. Sometimes near the close they do that in the last hour. But certainly this trade is one where pinning works against you. If the stock really does hover at a strike price or pin to a strike price, then this trade would be the wrong trade. And in fact, the reason this trade has gotten so good is that pinning behavior has gotten so weak in the last couple of years since the weekly options have really taken off. And I used to make a lot of money myself personally selling naked puts and calls. I used to sell straddles on stocks like Google that would pin to a strike price, and they would move up and down just a penny for several hours. That behavior has been extinguished, and I think it's because that was an inefficiency that stayed in the market for a long time, and the market has become so efficient that it extinguishes that behavior very quickly. And the reason is you have millions of people coming in and trying to sell straddles at the strike price, and it depresses the option prices at that strike. Straddles become a better deal for the institutional traders. They take the long side of various structured positions around that strike, and then they have an interest in seeing the stock then you have people come in and buy the stock or short the stock and try to move it so that they can make money on an option trade. And so the whole pinning scenario has failed much more often than it has succeeded in the last couple of years, mostly because the options market has become so efficient that it's extinguished that opportunity. But pinning was actually a distortion in the option market, because it meant that when a stock was sitting at a strike price, you could sell a straddle and have a statistical advantage that would make money by the minute. And I spent a lot of time doing that, but I don't do it anymore, actually. I do it a little bit with some special indicators that I have where I watch the stock very closely and I can tell when it's beginning to inch away from the strike price. But this is really a much better way. And yes, this is definitely, whoever said that is correct. It is the anti-pinning trade. This bets against pinning.
Right. And that, it really brings out a very important point that I think spans all forms of trading, which is, some things work for a certain length of time and they just stop working for whatever reason. You can dissect the elements and understand it, but it's not as though every trade you come up with will work forever. And
right.
You have to be intellectually curious, and you have to have flexibility in your thinking to find what is working.
Right, and, that's right.
I think that's kind of the essence of what this is about.
You have to be flexible, and also a lot of these things that people do work in bull markets or bear markets, or they work when the market is active or calm, or different types of markets. I try to really focus my efforts on things that just work because they work, that they're not tied to any particular market scenario or direction.
Now we're getting a whole cluster of questions around what vehicles are good to trade, and there's a related series of questions about indices versus individual stocks. Have you had success on the indices or more success on individual stocks, and sort of how do you select the stocks that you would use this trade for?
Well, whenever you want things to blow up, stocks are better than indices. So the indexes are an average of a lot of things, and you don't get the kind of movement. Indexes don't report earnings. Indexes don't have surprise news. The CEO of an index never gets indicted and put in jail. Indexes don't get charged by the SEC for insider trading, that kind of thing. Stocks do all those things. Stocks are much more. I know people who do condors and sell condors, short condors for a living, and they tell me that they always do indexes. They make their money from time decay, and they always focus on the S&P or the Dow or the Russell or something like that. Because if they use individual stocks, they always lose money, because stocks have a much poorer fit to the normal distribution curve that's used to price options. Indexes actually fit the normal distribution curve, the log normal curve of option pricing theory. Indexes actually fit that much better. And of the stocks, the best stocks are the ones that are in the news the most. In fact, you can pick the stocks to do this on by counting the number of press releases a day that mention that stock. Apple is a great one to do it on. Netflix, Amazon, Baidu, those kinds of stocks are excellent because they're in the news, they're institutionally traded, they're manipulated by large banks, there are algorithms trading them all the time, computers all over the world, people in other countries. I mean, there's just so many things. Apple has bonds, they have options, They have their own futures. They have their own VIX. They have Apple VIX. There are people betting on Apple rising or falling volatility, and there are people trading the stock and hedging with options. There are just so many people involved in Apple in one way or another for one reason or another that it always has movement, and it's a very poor fit to the normal distribution. It has much higher volatility intraday than it does overnight, and it has much different volatility month to month than it does week to week. It's just a very distorted kind of a thing. And it's so big that they can't put it in the Dow ever. They'll never put it in the Dow because it would distort the Dow. Apple moves $10, which is normal every day, and it moves the Dow 80 points every time it does that. So it's Apple's very special. And the other stocks like Apple are Netflix and Amazon, things like that. So they're big names, traded by institutions, followed by lots of algorithmic trading systems. That's really the most important. The ones that the high-frequency traders focus on, the ones with all the volume and the big open interest in options, those are the ones that you want to do.
All right. I think we're going to take one more question, and then we'll tell everyone how you can get involved in becoming educated on how to trade this. And that is, what is your next book going to be?
I really...
Are you writing anything now?
This is an interesting thing. I really enjoy writing those books. It sharpens my thinking. It makes me a better trader, but it takes enormous amount of time. And I wanted to write another book, and I wanted to write a book on the weekly options expiration very specifically. And I thought about doing it. I started doing it. It's the book that needs updating the most of all of them because the book on the options expiration book was written before the weekly options. And so that book really needs updating. And one of the other books, the workbook, the second edition of the workbook, has a section on the weekly options that includes weekly options. But I would really enjoy writing a whole book on that. The problem is I haven't done it because I've been consumed with this other activity that a lot of people know about. I've been developing for a decade a set of indicators that I use for day trading, and they're very unique indicators. They actually respond to the behavior of program trading systems and high-frequency trading systems. And so they're not based on any existing algorithms or any other type of indicators. And in fact, I've built around that a subscription service with a business partner I have, and we have a large group of very active subscribers who trade with these indicators all day. And so we do live trading rooms, and we trade options too, by the way. So we do live trading rooms with our subscribers, and we actually do something no one else does. We go live with our own accounts and real money in the real market in front of everyone with no net, so to speak, and we trade in front of everybody using these indicators. So I've put so much focus into that in the last year and a half that I set the books aside, and I've actually been thinking about stepping back and writing a book on the weekly options expiration, but I've also thought about writing a book about day trading options and day trading options with these indicators and things. So it's just a time thing. I also discovered that you can convey information much more quickly. It's a lot easier to get information to people by writing things that are shorter than books. Books take a long time. It takes me 20,000 hours to write a whole book. But you can do a much better job by writing a paper and just publishing the paper somewhere. So I've been thinking about starting to submit papers on some of these topics or make videos or something. And it's a much quicker way to take some information, package it up, and get it in front of people than to write an entire book. Books are actually a little bit almost becoming out of date in a way. You can do better with individual.
My 89-year-old mother sits with her iPad and reads books all day.
Well, I do too. I mean, I read a lot of books. I mean, I'm a big book person, and obviously I like writing books. But I think in a technical market like this, sometimes papers will do the trick. So what you might start seeing from me, and I'm very flattered that anybody would even ask. Honestly, I am. But what you might start seeing from me is some interesting technical papers